Hi, I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. So we're going to be a little late today. Bloomberg has, for those that have Bloomberg, you understand that there's been just constant issues with EIA data, API working, not working. So I caught the wrong end of APIs not pulling in. And the sheet that I've used now for 13 years, 12 years. So you get an idea of how many things are built off of that one spreadsheet. So I was able to create a workaround. So some of the charts will look a little different, but it was the best I could do in short order. So we're going to go through things, 3 different sections, and we want to look at how the draws are continuing in the U.S., but the physical market is showing some problems, and we want to introduce that in segment 1, and then really drill down further in segment 3, when we're looking at just crude on the water. It's at a record-setting pace. What is it because of Russia? Is it because of slower demand? And we're going to mix and match, because the answer is both, but we want to go through that in pieces. And then in segment 2, we're going to look at how demand had a nice spike. A lot of that was on gasoline, but more of that was mathematical than it was actual. And we want to look at where things are, because right now we still see 8.6 to 8.7 million barrels a day of gasoline demand. Gas Buddy kind of reaffirms that, and we want to just go through is like making sure that we're not going crazy when we look at some of those different data sets. So with that being said, we're kicking right off looking at the total oil and product. Surplus narrowed from 65.6 to 42.5. But so some of this was a rejiggering, because this is showing 2 weeks ago, and we'll show you this past week how we've actually had a big increase in transit. So some of this was going from transit to floating storage, from floating storage onshore, but we also had some nice drawdowns on products, which when you look at, we had EID, we had some other, some things that are gearing up, especially when you look at Chinese Labor Day, and which lead into Golden Week and some of the key pieces. So again, there's a lot of moving parts with that. And when you look at the total crude stocks, land and floating, that's where you saw some of the biggest shifts, because when you look at surplus now from 59.2 to 32.6, a lot of that was this switching over from floating to onshore. Some things were going from floating to transit, which is why we talk so much about the transit market, because some of it it's still in the water. It's just going now from point A to point B. So we want to keep track of it. And then total oil product stockpiles went from 6.4 to 9.9. That some of that's actually going to come down, and we'll talk more about that with Fujairah and others, but we do see that remaining a bit elevated, which is why we're going to talk throughout not only this segment, but also segment 3, the potential for some additional run cuts. Economic run cuts and refinery run cuts. So total land storage, the deficit widened from 14.1 to 15.3. West of Suez declined from 4.8 to 6.7. East of Suez, the deficit now from 9.3 to 8.6. So still, fairly comfortable in this kind of flattish area. The interesting piece is going to be Europe, because Europe still has a massive amount of crude sitting in floating storage, and it's going to be a matter of when some of that happens. And then in the U.S., right now is when we normally start to have draws, because you have refiners kicking back up, imports not really keeping pace yet. So it's a matter of just kind of marrying these two together. So typically is when we get a bit of a draw, but we'll see how that continues. And because it's really not so much the draws, it's the rate of change of the draws, which we'll talk about in a minute. Total floating storage, the surplus widened from 29.5 to 29.6, still staying at the high end. And a lot of that is being driven by west of Suez. The surplus widened from 8 to 10.6. That remains a mixture of the U.S., West Africa, Europe. So Europe, some of that has come down. West Africa actually had a big bounce, so we want to talk more about that in later on. And then the U.S. Gulf Coast continues to be fairly elevated. The surplus narrowed in the east of Suez from 18.2 to 10.1. All of that really being driven by Asia, and we'll talk more because some of that Asian product has come on shore, but there's now a huge slug of additional product coming to replace essentially what has been drawn down. And those are some of the key pieces. But when we look at the floating market, there's still a record amount of crude on the water, a record amount of crude in transit, and it's actually approaching the 2020 highs. Now, if you look at timing wise, the 2020 highs didn't happen till next month. But so far, when you look at where we are, so seasonally adjusted, we are at the highs, but we're trying to look at peak to peak to get an idea of these different levels. And you're seeing this fairly sizable push, but all of that's happening at the same time you're getting a lot of pressure really on crack spreads, where crack spreads are getting just hit extremely hard. We've had Singapore go from $8 to $2 on distillate. You've seen the U.S. continue to weaken. And one of the things that we talked about in the U.S. was that you were going to kind of get a cap on exports because of that Russian product hitting the market. And again, we don't have the chart for it, but there's over 5 million barrels of Russian distillate just sitting in floating storage. So there's more than enough to continue to come out. And that's going to, again, put pressure on U.S. exports, which we think is going to shift some of these storage numbers for the worse in terms of builds on the refined product side. But those are things that we want to talk about as we go through this segment into the next one. Crude stock, Drew, it fell 5.05 million. The draws were driven by, as you can see, Pad 3. Pad 3 had a drop of 5.43 million. Everything else was fairly stable. Pad 3 still elevated versus the 5-year. When you factor in the SPR, there was a drop of 6.08. One of the things that keeps coming back and forth is the U.S. going to start to refill? And I think it's early. If it happens, it's going to be at the end of the year. We will start getting some inflows because if you remember, the first tranche was actually lent out. It wasn't sold. So there's going to be a mixture of how much of that comes back plus interest. And you could take multiple terms. So it's also a matter of what terms were taken. So that's going to be one to watch as we continue down that rabbit hole. Crude oil inventory excluding SPR. And this is the key piece. When you start looking at these reductions, when you look at what happened in 2021, when you look at what happened in 2015, you typically get to a point and then you start to get this drop down. You could see that the fall started a little bit earlier. The rate of change is a bit harder than some of the than in 2021, just using that as a kind of a bellwether. And a lot of that excess drawdown is because we still have massive exports. Exports still remain robust into both Europe as well as Asia, and those are going to be some interesting pieces to continue to follow. Then when you look at the total oil storage and products, you can see that we're tracking, a little bit to the downside, but one of the things that we believe is it's going to be more of a sideways move that is going to continue along that path. And it's going to be a matter of, where does storage go? And we're going to talk about how imports for gasoline have surged. And because some of the discounts that have started on the shipping side, we think you're going to be more gasoline exports coming into the U.S. markets. This is just looking at Pad 3, and the key piece is where that drops normally come, and you can see from 2021 when you look at 2018, you normally start to get these declines. The question is always going to be what is the degree of them in terms of rate of change. Our elevated exports, reduced imports is keeping us moving in this direction, but you could see it's still at a very comfortable level as some of these exports start to build up. Not to say that we're going to go above the 5-year average on the export side. And the issue is that we're not going to have to. And the reason why we won't have to is because the impact to our refined product exports are going to be a problem when we start looking at run rates and what's happening on the coast. So now you look at crude oil storage in Cushing, you can see things kind of flattening out. And this is just what we were saying. It wasn't going to keep going down. It was going to kind of flatten out. We had another drop in Pad 2 and Canadian imports or Pad 2 imports. That's going to bounce, and we'll show you some of those charts. And that's just going to keep a bit more in storage in Cushing. But as long as exports continue to be at this level, we don't see this moving up or down in any meaningful area. It's just going to kind of stay range bound. Yes, there'll be pivots up and down, but averaging out to something right around these levels. Then you look at the refinery inputs. For those that have been following us, we said that we should be between that like 89, 93. But realistically, over the next few weeks, we expected to be between that 90 and 92. And here we are, a small increase of 30 basis points to 91.3. The increase was mostly pad 5. That's really going to be the case. And when you look at this on the chart, you get an idea of why we're saying that. It's just because we're already kind of at the seasonal norm. The problem is because we've shuttered the refiners that we've closed to this point, a refinery run rate at this level doesn't mean the same thing that it once did on a throughput basis. So again, here's some interesting pieces here, seeing things kind of settling at this point, which I think is a fairly interesting backstop. Imports were up slightly, 82,000 barrels a day. Again, it was driven by pad 5. As we've been saying, pad 5 is going to be very lumpy. Pad 3 still remaining a bit depressed. Some of that's going to bounce. It's still going to stay fairly low just given where we are right now. But then pad 5 again is going to be that lumpiness. But pad 2 is going to be the one to watch because pad 2 had a small drop of 80,000 barrels, but we do see that again bouncing back up just given some of those different flows. Pad 3, as we were saying, staying in the middle of the cloud, below the 5-year, the lower end of the cloud, but again, right in that middle piece, we don't see too much up or down at this point. If anything, it could trend up. And when you look at that 5-year average, you can see that there's normally kind of that spike. It's just going to stay within this realm. We don't see anything. There's no deals out there, so that's not like refiners are like, oh, this crude is so cheap, we have to go buy it. It's just they're going to take what they need and try to balance it out. Pad 2, on the other hand, there still is some discount, but you can see that it fell along seasonal lines. We will get that bump. And it still stays above the 5-year average. It's going to remain above the 5-year average. We don't see that pivoting just given some of those demand, especially for the heavier barrel. Implied demand, jet fuel was in that 1.53. Again, we said 1.45, 1.55, very comfortable there. Distillate slowing down again. We see actually more downside at this point. Just given where we are on the cycle. Things got a little bit cooler for the weather, so you're still getting some heating demand on the overnight, but again, that's slowing, and that'll continue to slow. Gasoline had a massive bounce. It went from 8.5 to 9.5. Now, one of the things that we had said is that it was going to go to 8.5, 8.4, and then bounce back up to about 8.6, 8.7, 8.8, and then kind of settle out at that 8.6, 8.7 level. Instead, you got this massive move. And it's something that's going to be, I don't know if it was timing, if it was the Florida component, because if you remember, Florida had a lot of, and not to say that all of this, because it's 1 million barrels a day, that's massive. But, there was a Florida issue in terms of some of the stations that were running dry. I am comfortable saying we're at 8.7. So I think some of this will average out. So this could mean that next week we get a stupid low number, like an 8.1. And you have to think about, this is just a calculation. So this is a metric that can fluctuate. And that 4-year average, that 5-year, that rolling average is a 4-week rolling average is more important. Propane, continuing to slow, a lot of that being driven by petchem and obviously the weather side. And this just puts into perspective where there are points when you look at the seasonality of it, as we were showing, we were too low. Now we're too high. And again, it'll settle out something closer to, if you were to do the averages, probably 8.7, which is actually where Gas Buddy is and some of the others. And I think that's really the right number at this point. It's still on the lower end, but again, we're coming into May. We're coming into Memorial Day. We're going to get some of that kicking off. And it's just, we think that summer driving is going to disappoint a bit to the downside. And that's going to put some headwinds on things. Crude oil supply, again, fairly normal, just given where we are this time of year. Gasoline storage, had a small drop. Typically we start to see some of this movement left, to sideways at this juncture. The biggest component on what gasoline storage is going to look like is going to be the export market and the import market. Because our exports are slowing, we see that becoming a bigger problem, which is going to put more into pad 3. But then at the same time, we see more imports starting to kick back up, coming from Europe into the US. And that's where we think that you're going to get some builds starting a little bit earlier than normal, because we do get some builds that come towards the end of May. It's likely could start a little bit sooner. And that's, again, just going to put us into a more comfortable position versus where we are, just because this kind of level is going to attract some of that flow and based on the ARB from Europe into the US. Distillate flatlining, obviously the weather was helpful. The question is going to be when do builds start, and because of that distillate just sitting in the ocean from Russia, some of that slowdown on the economic level, we see impacts to U.S. exports, which is going to push this distillate higher. Jet continuing to rise. Again, it's that balance between jet fuel, distillate. So we don't think that this surge is anything really concerning. When you look at the curve, we're a bit in no man's land. We've moved a bit back into backwardation. Again, there was things, if we were to update this, because unfortunately it took me a while to build everything, and the crude markets have fallen back down, moving things slightly into backwardation. But you get an idea that at this point we're just going to kind of sit between this 70, around 75. Could we go to 72 in WTI? Sure. But realistically, we're going to kind of sit at these levels. And the bigger shift here is you can see that bounce in floating storage. That's why when we talk about some of those imports, we do see some of those imports starting back up, especially into PADD 3. And this is that marrying with where are refinery run rates, where's the heavier crude. So we do see floating storage increasing a bit, but it's going to be that balancing act and timing. When does it show up? When does it get pulled in? When does it get filed? So again, those are things that are going to create some of those lumpiness. But again, that's why we look at things on the average, where things are moving. And we do have some additional crude coming into the U.S., especially on the heavier front. That's what we have for you on the kind of that broad overview. The next segment, we're going to go deeper into the U.S. refined products. And then in the third segment, again, going abroad and looking at some of the bigger pieces within it.